Hey, what's up everyone? It's Lucas here, and welcome back to the channel. Today we're diving into a topic that's super important in investing. You might think you need a ton of money to get started, but that's not true at all. In fact, you can start investing with just $100. We're gonna break down everything step by step, so you can start growing your money like a pro. Whether you're saving for a down payment, retirement, or just want to build wealth, this video is for you. Let's get started. Now, you might be wondering, why is it such a big deal to start investing early? Well, when it comes to investing, time is your greatest ally. The earlier you start, the more time your money has to grow, and that's where the magic of compound interest comes in. Imagine this, you invest $100 today, with an average annual return of, let's say, 7%, that $100 could turn into over $1,000 in 30 years. But if you waited just 10 years to start investing, you'd need to invest significantly more to reach that same $1,000 goal. That's because you'd be missing out on a whole decade of compound growth. Think of compound interest like a snowball rolling down a hill. The longer it rolls, the bigger it gets. Your money works the same way. As you earn interest on your initial investment, that interest then earns even more interest. Past performance is never a guarantee of future results, and the stock market has its ups and downs. But over the long term, the stock market has historically trended upwards, averaging around 10% annual returns. The bottom line is this: the sooner you start investing, the more time your money has to grow exponentially. Don't underestimate the power of compound interest. It's like having a personal money-making machine working for you 24/7. All right, now that you understand the importance of starting early, let's talk about setting financial goals. Investing without goals is like setting sail without a destination. You might end up somewhere, but it probably won't be where you want to be. So what are you saving for? A down payment on your dream home? Early retirement? A college fund for your kids? Write down your goals and put a price tag on them. This will give you a clear target to aim for and help you stay motivated on your investing journey. Once you know your goals, it's time to figure out your risk tolerance. This basically means how much of a roller coaster ride you're willing to stomach when it comes to your investments. Are you comfortable with potentially losing money in the short term for the chance to earn higher returns in the long run? Or do you prefer a more conservative approach? Generally speaking, younger investors with a longer time horizon can afford to take on more risk, while older investors may prefer a more conservative approach. Finding the right balance between risk and reward is key to long-term success. Now let's talk about one of the most important concepts in investing: diversification. You've probably heard the saying, "Don't put all your eggs in one basket." Well, the same principle applies to investing. Diversification means spreading your money across different asset classes like stocks, bonds, and real estate. It also means diversifying within those asset classes. For example, instead of putting all your money into a single stock, you might invest in a mutual fund or ETF that tracks a broad market index like the S&P 500. If you invest all your money in a single company and that company goes bankrupt, you could lose everything. But if you spread your investments across different companies, industries, and asset classes, you're less likely to be wiped out by a single event. Diversification helps to reduce risk and volatility in your portfolio. By diversifying your portfolio, you're essentially betting on the overall growth of the market, which has historically trended upwards over the long term. Okay, so you're ready to start investing. But where do you actually put your money? That's where investment accounts come in. There are a few different types of accounts you can choose from, each with its own set of rules, fees, and tax implications. One of the most common types of investment accounts is a brokerage account. This is basically just an account that allows you to buy and sell stocks, bonds, ETFs, and other investments. You can open a brokerage account with an online broker, a traditional brick-and-mortar brokerage, or even a robo-advisor. Another popular option is an individual retirement account, or IRA. IRAs are specifically designed for retirement savings and offer some nice tax advantages. There are two main types of IRAs, traditional and Roth. With a traditional IRA, your contributions may be tax deductible, meaning you don't have to pay taxes on that money until you withdraw it in retirement. With a Roth IRA, your contributions aren't tax deductible, but your withdrawals in retirement are tax-free. Now let's talk about what you should actually invest in. When you're first starting out, I recommend keeping things simple and sticking with low-cost index funds and ETFs. An index fund is a type of mutual fund that tracks a specific market index like the S&P 500 or the Dow Jones Industrial Average. Instead of trying to pick individual stocks, which can be risky and time-consuming, you're essentially buying a tiny piece of the entire market. ETFs, or exchange-traded funds, are similar to index funds in that they also track a specific market index. However, ETFs are traded on stock exchanges, just like individual stocks, which makes them a bit more flexible. Both index funds and ETFs offer a number of advantages for beginner investors. They're low-cost, diversified, and easy to understand. Plus, because index funds and ETFs are passively managed, they typically have lower fees than actively managed funds. Now, here's a crucial tip for building wealth. Make regular contributions to your investment accounts. It's not about timing the market perfectly or finding the next hot stock. It's about consistently putting money to work, month after month, year after year. One of the best ways to do this is through dollar cost averaging. This simply means investing a fixed amount of money at regular intervals, regardless of market conditions. For example, you might decide to invest $100 on the first of every month, no matter what the stock market is doing. Dollar cost averaging takes the emotion out of investing. When the market is down, you're buying more shares at a lower price. And when the market is up, you're buying fewer shares at a higher price. Over time, this strategy can help you average out your purchase price and potentially reduce your overall risk. Even if you can only afford to invest $50 or $100 a month, it will add up over time, especially with the power of compound interest on your side. Finally, let's talk about the importance of staying informed about investing. The world of finance is constantly changing, so it's crucial to stay up to date on the latest trends, news, and strategies. Luckily, there are tons of resources available to help you, both online and offline. Read books, listen to podcasts, follow reputable financial news websites, and subscribe to YouTube channels like this one. The more you learn about investing, the more confident you'll become in making informed decisions about your money. So there you have it, guys. Investing doesn't have to be complicated or intimidating. With just $100 and the right knowledge, you can start building a brighter financial future for yourself. Remember to like this video if you found it helpful and subscribe to the channel for more finance tips just like this one. Hit that notification bell so you never miss an upload. Thanks for watching and happy investing.